Good day, everybody. It's Eric Coffin here from Vancouver. Fantastic day. I was pretty tempted to actually do this out of my deck, but I've been having enough problems with my Wi-Fi. I decided not to tempt fate. Welcome to the second block of today's 3 blocks of the June 2020 Virtual Metal Investors Forum. I'm Eric Coffin, editor-publisher of the HRA Advisories. I'm here with 4 companies that I have under active coverage. I'm just going to give you a sort of a quick market overview, more general macro stuff. Go through that a little bit because it's one of the craziest markets I think any of us have ever seen. So let's just move on to our presentation. There's a lot of words on these slides. So if, don't have any concerns about that, keep in mind you're all going to be getting a copy of this. So, don't feel like you got to take notes of all this stuff. My whole point to doing the slides this way was so that you'd essentially actually have the notes when you go. Essentially we've got a situation that there's really no roadmap for this. There's no simple, obvious thing you can point to in terms of what the market's going to do, what it's going to look like. It is completely unprecedented. We've never seen this scale of intervention by central banks. We've never seen this scale of intervention in terms of fiscal spending either. I was expecting the central banks to do what they did. I'm a little bit surprised at how much a lot of the G8 governments have stepped up. But essentially what this generated was probably the shortest bear market in history. And that's assuming you're not thinking that we're still in a bear market. Technically, we're not, because things come all the way back up. I think we may still see a pullback here. That's part of what I'm going to talk about. But essentially, the bear market came, it went. We've actually seen the strongest rally in terms of consecutive day move. Again, in history. I think everything this year seems to be the biggest in history. There's no fear in the market right now. And this is really all about Fed put, but a lot of it I think is probably the fiscal intervention too, at least for the current period. There's been so much money going out to individuals, both in Canada and the States and Europe. I think that's given people a lot of comfort. And that's something that I think is going to continue as long as the fiscal regime continues, and that we still don't know yet. Things did get extended in Canada, for instance. They've yet to be extended in the States, but we're going to have to just see how that pans out, because that's going to probably have a big determining factor on when we move into the next phase of this. Essentially, if you look at the 2 charts on the right side, the one on the top is it's sort of the panic euphoria model that Citigroup has, and you can see right now we're well into the euphoria phase. And frankly, if you'd asked me a month ago or 2 months ago whether this chart would look like this early in June, I would have honestly thought you were crazy. But this is what we've got. We've gone from everybody freaking out to everyone being utterly euphoric. And it's bizarre when you take a look at that in the context of the lower chart. The lower chart is a very long-term chart, goes back about 50, 60 years. And what that is a measure of the percentage of the world economy, the percentage of world GDP that it's currently in recession. If you look at the right side of the chart, we're at about 93 right now. It's never been that high since the Depression, essentially. Again, it's essentially it's unheard of for it to be that high. But at the same time, we've got the market back almost to all-time highs. I'm not even going to pretend that makes sense to me. But it's just liquidity. That's what the market runs on. That's all the market cares about. And that's what the market's getting plenty of right now. Now, if you look at this shortish term 6-month chart of the S&P. Again, you can see the huge drop in March, came all the way back up, got almost back to its old highs. Nasdaq did get to its old all-time high. You can see that it's pulled back a little bit in the last few days. That's mainly due, or at least the blame being placed for it, is the resurgence in the COVID cases, particularly in the U.S. I don't know whether it's that, frankly, or that it just got close to the all-time high, and traders started backing off again. If you look at the right-hand side of this, I find this chart quite interesting because this tells me a lot about, who's active in this market right now. That's about a 3-year chart of open put and call option positions on the S&P index. Red's the puts, blue is the calls. As you can see, there's, again, unprecedented volume. Obviously, things spiked up as you'd expect on the put side in March because everyone was freaking out. Everyone was trying to buy protection for a falling market. You look at the call side, that rose too because there were probably people doing straddle trades. But in the last little while, the call option volume has just gone crazy, and it's particularly gone crazy if you look at what's classified as small speculators retail. That is at amounts that we've never seen before, like never, ever, ever. It's several times as high as it's ever been any time in the past. There's been this huge influx of, I guess, bored punters that don't have sports to watch. They've got nothing to bet on, and they've all decided to open these Robinhood accounts and jump into the market. We've never really seen anything like that. And this is an added weirdness to it. Now, one thing I want to point out is part of what's driving this has really been the narrative that we're getting out of the financial media. And if you look at what's come out in the last couple of weeks, the most recent piece of large, hard data was retail sales. That was presented as being phenomenal, fantastic, unbelievable, best ever, up 15%. Which it was. I'm not saying the number was false, but the chart on the left, which is a longer term chart, and shows you year over year increases. If you take a look at the right side of that chart, you can see this massive spike down. There is a bounce up this month. It was up 15%. That's true, but it's still about half of what it was a year ago. So you got to keep these things in context. And another thing on the right-hand side, and this is, again, a pretty current chart. This is U.S. restaurant bookings. I believe this was pulled together out of Open Table. You can see what happened in March. Obviously, everything shut down. They went to more or less to zero. And, yes, there's been this bounce, but, again, the bounce is really getting back to about half of where it was before. And it's interesting. I don't know whether it's ominous or it's just a fluke in the data, but if you look on the right side of that, there's another dip, and I don't know if that's, areas came out of lockdown, people went out to dinner once, decided it was too much of a hassle, and then just decided not to bother again. I'm hoping that's a fluke in the data because it's not a great sign if it isn't. But again, all of this stuff, we're only going to see this roll out over the next 3 or 4 months. We won't know until we get through that period just how this stuff's going to shake out. Now, if you'll take a look at these two things, basically, there's two items here. I mean, it's hard to read this chart. Unfortunately, it's not very large. One of them is the retail sales that you just saw on the previous slide, and that's where you see this fairly large bounce. That's sort of that little middle red box. The other one where there hasn't been much of a bounce is industrial production, and that's the side of things, the hard numbers, the production, the supply side of the economy. That's what we're going to have to really keep an eye on through the next 3 to 6 months, because really that part of the economy, that half, not just the demand side, but the supply side is really where the jobs are. So we've got to see that bouncing. That bouncing is what's going to determine really how many people that are furloughed, and there's about 40 million people furloughed now. How many of those people get called back? How many of them simply don't get called back? How many of those small and medium-sized businesses that don't have very large fiscal resources just call it a day and throw in the towel? We're not going to know really how any of that pans out for at least, I think, 3 or 4 months. Everything should look great this month. It should look pretty good next month. It's really going to be when those programs start to roll off that we're going to find out how things really look. So essentially, I think if we see a successful reopening, I think if things go well, I still expect to see U.S. unemployment rate in the 10% range at the end of the year, probably that or a little bit higher in Canada. Those are not good unemployment rates, as I'm sure you know. Those are essentially recession scale unemployment rates, and that's me assuming things actually go well. If things don't go well, it could be worse. Do we see more fiscal programs? Canada has extended theirs by 6 or 8 weeks. The U.S., theirs still basically rolls off between the middle and the end of July, their payroll protection program. The jury's still out on whether that's going to be renewed. There seems to be a lot of resistance in the Senate to do it, but there's been recent conversations about doing other types of stimulus as we get into Q3, whether those directly impact what people get in their pockets and by that directly impact things like consumer spending is yet to be seen. I'm not unaware, of course, that it's an election year in the U.S., and I think regardless of the party or regardless of what somebody's official position is when it comes to things like deficit spending, politicians tend to have pretty open wallets when they're heading into an election. So I think, maybe we do see some more fiscal show up. The other thing to keep in mind, though, is that this market right now, I don't think I bothered throwing the chart up. It was in the last journal. If you look at the S&P levels, and you compare that to essentially the going forward, the projected earnings, the divergence is the biggest I've ever seen it. I mean, earnings actually started falling. I was expecting at least a mild, maybe not a full-on bear market, but certainly a correction early this year before COVID even showed up, because profits for the S&P had been flatlining for actually 3 or 4 quarters, pretty much all of 2019. They started falling harder first quarter this year, and of course they fell off a cliff second quarter for obvious reasons. Like things like retail sales, yes, we will see some of those bounce back. They aren't going to bounce back that fast, and right now we probably have the biggest divergence between the S&P levels and projected earnings that we've ever seen in history. Yes, those two things can diverge. They can diverge for, sometimes quarters at a time. But if you look at long-term trends of both the major indices and earnings, it is at the end of the day earnings that determine those index levels, and they will converge again. The question really is, do they converge because earnings come back up, or do they converge because the S&P goes down? I think it's probably going to be a bit of both, but I don't personally see the earnings coming back that quickly for a lot of these industries. It's going to take time for the companies to get past this. Even if things go really well from here forward, this was such a big dislocation, you're not going to see profits come back quick. Basically, the real spending, as big as Washington has been, the real spending, of course, has come out of the Fed. The Fed's added about 3.5, it's almost 4 trillion now to their balance sheet. My expectation is the Fed balance sheet gets to 10 trillion by the end of the year. Interestingly, 2 or 3 days ago, there was a book published by a fairly well-known U.S. professor who's a specialist in what's called modern monetary theory. You're going to be hearing a lot of arguments about whether MMT works or not. The truth of the matter is they're essentially practicing it already in Washington. I don't think you'll get anyone to admit it, but they are, in fact, simply monetizing the deficit right now. The Treasury is issuing Treasury bills to pay for deficit spending. The Fed is essentially the only buyer in that market and has been for some time now. So in effect, you've got the Fed buying the Treasury's debt, which is monetizing the debt. That's what that is. That's what all the hard money guys warned about for years. You're basically seeing it right now. The question is, what's the end date what's the end game for all of this stuff? It's really difficult to say. Nobody really knows what this is going to look like. But we do know that the Fed, I think, is probably more worried about the economy, or maybe they're just being a bit more honest. I mean, politicians, obviously, part of their job is to try to keep everybody calmed down, so they give you the happy talk. The Fed is sort of mandated with that too, but I've noticed the last couple of meetings, Jay Powell he's clearly concerned that this bounce is going to run out of steam. As soon as you saw rates start rising a little bit 2 or 3 weeks ago, they started buying pretty hard in the market to bring those rates back down. And in the last Fed meeting, Powell was very clear, promising you're going to see zero rates at least until the end of 2022. And they're buying in other markets, corporate debt, mainly in the LQD. They're not yet into the really high risk stuff, although they're threatening to buy that as well. And I suspect they probably will before this is over. They're essentially just trying to put a bid under everything to keep rates down as low as they can for at least a couple of years. If it's not obvious, this is about as good an environment as you're going to get for gold in particular, but commodities generally too. One thing that I was a little concerned about going into this mess, when you get this big a dislocation, this big of economic shock, it's not uncommon to see the U.S. dollar really move higher and really go hard. The reason for that is simply it's a safety trade. It's considered one of the ultimate safety trades. It's one of the most liquid markets in the world. Big traders tend to hide in the dollar market when things get ugly. And you did, in fact, after the initial drop, see this big run-up in late March, and it looked like maybe that was it. But interestingly, and a lot of this, again, was Fed and other central banks. The Fed put out swap lines. Other central banks may be doing things in their own market to try to constrain some of the dollar demand, because where this demand's coming from is you have all these offshore lenders that board in U.S. dollars, and now they're all scrambling to get currency to pay this stuff. But we have seen the dollar, much to my relief, at least so far, it's actually had a big down leg in the last little while, and it's actually at the bottom of its trading range for the last few years. I don't think we're totally out of the woods. I think there's still a possibility that we would see a run higher in the dollar. But if this is central banks actually controlling the market and keeping it down here, they're doing a better job than I honestly thought they would. And of course, the nice thing with the U.S. dollar getting weakened is it's got very good negative correlation with commodities in general. Gold hasn't actually been that well correlated with the dollar lately, which is fine. But a lot of other, a lot of base metals are, a lot of the basic materials are. So if you're somebody that follows commodity stocks, it's nice to see the dollar doing this. In terms of base metals, copper's actually done better than I feared that it would. If you take a look at that copper chart, if you've got a chance when you've got your hands on this deck to flip back and look at the S&P chart, the correlation between copper and the S&P for the last little while has been just amazing, actually. It's very close to one. That tells me two things. One is that there's obviously clearly a lot of optimism out there. There's people expecting the economy to bounce back smartly. They're going into the copper market going long. That's the good news. The bad news is, I haven't seen that much drawdown in inventories at the LME or in Shanghai. And when I see not much change in inventories, in fact, the inventories have gone up a bit, and I see a chart that looks like this, that tells me that copper probably hasn't been going up because of, fundamental demand, because of people making wire or batteries or whatever buying copper in the market. It's gone up probably mainly because of spec traders. And I've certainly got nothing against spec traders, but just keep in mind that I think only part of this is fundamental demand. Part of my reason for that is if you look at the chart on the left, that chart shows you essentially a number of major indicators for China. China, of course, is where COVID-19 started out. It went into the nosedive first. It's come out of it, but if you look at the right side of that chart, you can see things flattening out. And their numbers aren't terrible, but they're also not back to where they were before. So I think we have to keep an eye on that to see whether we see the demand come up. We did have some supply disruption, which is going to help inventories. There were a number of areas where, particularly in South America, places like Peru, where there were copper mines shut down for a couple of months. A lot of those are coming back on stream. I'm not worried about copper. I think medium term or long term, the copper story is great. But I'm just saying, don't be surprised to see it. It's probably going to be choppy here for a while. So my expectations aren't that we're going to literally see it go right back where it was before. That's going to take some time. Ultimately, I think it's going a lot higher. I just don't think it happens tomorrow. Gold, of course, continues to be a big beneficiary of all this. That's going to continue. And there's two or three things I just want to point out when it comes to the gold chart, I've talked about this in the newsletter in the past. When you get into a recession and a bear market, which we've kind of gone into and out of, but the recession tends to have two phases. The early phase is what I call a liquidity crunch. That's that drop that you see in the middle of the chart. Basically, traders were selling everything that wasn't nailed down. The markets were falling apart. People just wanted liquidity. They just said, if you can sell it, sell it. Gold doesn't get spared. Nothing gets spared during that phase. When you come out of it and you're into the phase that we're just barely getting into now, which is what I call the insolvency phase, that's when the actual disruptions, the demand destruction that's part of a recession starts really weighing on companies, and that's when you start actually seeing business failures. Normally, I would have expected to see more of them by now, but we haven't seen that many so far, largely because of all this fiscal. This fiscal has been basically holding everything up for the last 2 months. As this rolls off in the next couple of months, I expect the insolvency phase to really kick in. You'll see bankruptcies really climb. You'll see store closings, things like that climb. All of that sort of stuff tends to bring in more fiscal spending, more of the sort of Keynesian cushion spending. That stuff tends to bring the market back into a inflation watch phase. Gold tends to do well in that stage. If you go back to 2008, 2009, there was a quick push higher in gold prices, but then there was a long, steady climb actually coming out of that recession when all that fiscal spending and additional monetary spending was kicking in. I think we'll see something similar here. So I think we'll see gold prices supported, probably move higher. But really, one thing, and it's different this time from any of the previous ones. I think most of the big actors, the big players in this market, everyone's looking at the size of what's happening, or the size of these deficits, the size of the monetary spending. Nobody, and I mean nobody, has any idea what the end game of this looks like. No one's got a clue. I have no idea what the end game is going to be for this stuff. I look at the combined fiscal and monetary spending going on around right now through the G8, how much they're adding to their debt load and to their deficits. I have no idea how they reverse that and bring it back to zero. Personally, I don't see any way to do that that's politically feasible. I mean, these are all democracies after all. No one's going to vote for a politician that would do the kind of spending cuts and tax increases that you'd need to bring it back. So I don't know what the end game is. Everybody's expecting some kind of a reset out of this. I mean, is it going to be we all go MMT? Is there going to be a debt jubilee? Are they going to devalue the hell out of the currencies to make it cheaper to sort of pay the debt back? Are they going to try to inflate their way out of it? I suspect they wouldn't mind doing that. I just don't know if they can. Central banks have had very little luck creating inflation. Most have tried for the last 10 years without much success. Everybody knows there's going to be some kind of reset. And the concern of that reset has a lot of people in the market. I'm not talking retail gold bugs. I'm talking large pools of money have been allocating into the gold space and into bullion, because when they look at this and they look at the markets and they're concerned about a reset, there aren't that many markets that literally aren't intimately connected to the rest of the financial sphere, which gold isn't really. I mean, if you own bullion, there is no counterparty risk. It's not tied in. Essentially, it's probably the most difficult market to screw with if you're going to be doing some kind of a reset. And I think the knowledge of that and the demand that that's pulling into the market is probably going to support gold prices for, I think, an extended period. I'm not a gold bug, but I'm expecting to see a strong gold market here. This could actually go on for a few years, depending on what the end game looks like. So I think we're all going to have some fun here. Things have been pretty good the last couple of months. I'm just going to leave it there. I just wanted to give you kind of big picture background.